Hey guys, welcome back to my YouTube channel. In today's video we're going to be talking about market structure as a whole. Okay, and please, if you're still finding it difficult to actually determine the trend of the market, or you're still having a lot of losses, so this video is actually for you. Okay, because we are just going to be breaking down market structure step by step. Okay, so we're going to be taking out each step by step, okay, from more or less like from a beginner to a pro, because we're just going to give you everything in handy in this particular video. And I don't want this video to be very long. Please endeavor to hit the like button, subscribe to this YouTube channel for more and more videos like this. The market structure for me is actually divided into three major categories. The category one is the swing structure, the category two is the minor structure, and the category three is the word substructure. So mainly what we are going to be looking at for is how to actually determine the swing structure and then the minor structure. So the substructures are of no concern for us. Okay, so we are going to be looking at the swing structure and the minor structure. What is the swing structure? Swing structure helps us to determine whether the price is bullish or bearish, okay? And it helps us to be focused with respect to where to buy or where to sell. So right here, let's look at this now. So the market is actually pushing to the downside, okay? And then we have a higher low. All right, so what happened in this case here? What happened in this particular case here, we have is what a break of structure. So after that break of structure, some people are actually looking forward for buy opportunities, but you being an advanced market structure trader, what you're going to be looking for is what a sweep of liquidity. All right, so after this sweep of liquidity, you understand what happens here is what a low is being taken out, and then the new low being formed becomes what our protected low. Okay, this low here is what our protected low, and then what happens? You expect the market to actually break what structure to the upside. So right here, right, we can clearly see what happened here. Okay, because this is just something that's tricky, and a lot of you guys are going to continue to fall victim for this if I don't actually take my time to explain it for you guys. And please just be patient and watch the video to the very end. So we have break of structure here. All right, so now before that break of structure, there are some people who are actually looking for retest levels and all of that. So but that didn't happen. What happened was what the market led to what a sweep of this liquidity, okay, that gave us what this new low. All right, so the market gave us what this new low, and this new low becomes what our protected low. Okay, so this new low becomes what our protected low. That man is always fond of that. So the new low becomes what our protected low, and then this here is what our break of structure, right? This is our break of structure, all right, before the market gives us what a new high. So this is what the break of structure, the BOS. So you see this, there is what a sweep of liquidity here. Okay, just taking my time to explain this, and then there is a break of structure here. All right, so those two things have actually been determined. Okay, so and then this new high, you discover that there's a new high being formed. There's a new high being formed at this area. Okay, so therefore that new high becomes what your protected high, and then the whole of the structure becomes what the whole of the structure becomes what our swing structure. Okay, the whole of that structure becomes what our swing structure. I don't want to waste time in explaining and making the video too long. The whole of this structure becomes what our swing structure. Take note of that. So that's our swing structure. The whole of that movement to that high is our swing structure. So where does the substructure come into play? Sorry, the substructure here. I think I made a mistake in the substructure. So where does the substructure come into play? The substructure come into play when there is retracement, those minor retracements to the level where you want to actually buy from. Okay, so and then it happens like that. So this is what you should be expecting to this is what you should be expecting to learn, and this is how you should learn to see the market. Okay, this is how you should learn to see the market. All right, so please guys, endeavor to hit the like button, subscribe to this YouTube channel if you like this particular content. Don't hesitate to hit the like button and subscribe. So the whole of this move is called what? Our substructure. These are substructure. This is the swing structure, and this is the substructure. So you know how to actually determine the move of the market. Okay, so and now there's a funny thing that comes into play. Okay, so now majority of you guys, what you're actually doing is you're chasing the market instead of waiting for the market to come to the area where you should be buying from. You want to actually be selling, or you want to be buying, and then you find out that you keep accumulating losses. Okay, you keep accumulating losses. So let me just go ahead and delete the whole of this, because there is something I still want to actually explain to you guys. So to actually determine the exact point where you'll be buying or selling, okay, so for you to actually determine the exact point where you'll be buying or selling, okay, you need to actually use the Fibonacci tool. So the Fibonacci from the swing low, that's the low where there was a sweep of the sweep that caused the sweep of liquidity. This low, that's the swing low. Okay, you pick your Fibonacci tool from that swing low to the high. The high, that's the highest point where the market got to. That's your protected high. Okay, you take your Fibonacci tool from there to there. So there you mark above the 50%. That's above this area from here and above. That's the premium zone. Okay, from there and above you mark it. That's the premium zone. This is our premium zone. All of this, everything above here is the premium zone, the premium. So this is our premium zone. So you don't want to be doing anything at that premium zone. So therefore you have the discount zone. This below the 50% is our discounted area. Okay, it's our discounted area. So I'm just going to go ahead and just change the color a little bit so that there will be difference. Okay, so we have the premium and then the discount. Okay, the premium and then the discounted zone. So you don't want to be taking any trade at the premium, so you just have to wait for the market to actually come here. So, but some people can actually, because of impatience, they can actually decide to take sells and then wait for the market to actually come here and then take their buys. Okay, but I advise you to stay patient, because when you learn the act of patience, guys, you discover that your win ratio is going to be high, and your risk to reward ratio is going to be high, and then your stress levels as a trader are going to be low. Okay, because you know you're doing what is right, guys. So please leave a thumbs up for this video, guys. Leave a thumbs up, right? Because I know I'm giving you the best of content. So let me just delete this. All right, so now let's assume that price comes into a discount. That price comes into the discount. So before the price gets into the discount, this is what you do. Okay, as price gets into that area, this is what you do. Right, just give me a minute. As price gets into this area, this is what you do. You just take your Fibonacci tool from here, from the swing low to where the break of structure happened. Okay, from here to where the break of structure happened here, from the protected low to where the break of structure happened, which is here. Okay, So therefore you determine what your premium and discount again. Determine your premium and discount again. All right. So you determine your premium and discount again. You mark it out so that you have the best of what entries, guys. You have the best of entries. So there are two models which I trade this. Okay. So before the market actually get there, you pick your tool, the premium, the premium, the discount. Okay. So you wait for the market. Then now you mark out your area. All right, where you be interested in to actually take your buys from. So when you mark it out, you just go ahead and delete the whole thing. Okay, you delete the whole thing and just wait for price. So when price gets into that area, okay, I advise you to use confirmation candles so that you can actually increase your win reward ratio, your risk to reward ratio. So you wait for the market to actually get to this area, and then you take your entries using the confirmation candles, which can be the inverted hammer, if for the hammer, the engulfing candle, and the others. So but if the trend is like this, you can use the inverted hammer and the hammer and all of that. So now let's look at the second example. All right, so I'm just going to go ahead and delete the whole of this, and then we'll look at some examples in the live market. Okay, so now the market is, remember, the market is pushing to the downside. Okay, and then suddenly we have what a break of structure, a false break of structure, and then a sweep of liquidity, and then there is another break of structure. Okay, so this model is the best of them all, the one I love to trade the most. And then we have what, a break of structure. Let me just keep it here. All right, let me adjust some parameters here. So now we have what, a sweep of liquidity. All right, so there are rules, okay, to this particular model, right, other than the other one. The other one is simple, but this one has more rules. Okay, for this particular model, there must be what, a sweep of liquidity, and then that sweep of liquidity provides what, a protected what, low. All right, secondly, there must be what, a break of structure. Okay, so there must be what, a break of structure. So now it's still the same thing, but there are other steps to it though. So there must be what, a break of structure. So now this is a break of structure. Okay, this is our break of structure. So now you pick your Fibonacci tool from here to that high point where the market got to, right? From here, from the swing low to the higher point where the market got to, and then what you expect to see is a pullback. Okay, pullback to this 50% or below the 50%, whichever one the market gives you. 50% at the 50% is at this good line here. Anywhere exactly here or below here or up to this extent. So anyone the market gives you, that becomes what, your structural liquidity. That must happen. Okay, it must be at 50% or below 50%. So anything above, you don't want that. So this is the second method. So that is to provide what, liquidity, to provide what, structural liquidity, that the market will come back to it and take it what, later. So after that happens, what do you expect? The second one is you wait for another what, break of structure to the upside. So you have another break of structure to the upside. So that break of structure, you have another break of structure to the upside. So this is our second break of structure. So this is our second break of structure, right? I don't want this video to be very long, but I think it's taking more time. So for that, please leave a like and subscribe to this YouTube channel, please. All right, so we have another break of structure. All right, so this is what our structural what, liquidity. All right, this is our protected low, and that is our protected high. This what becomes our protected what, high. All right, so and now this area here is our POI. POI stands for what, the point of what, interest. Okay, point where we are interested in taking our buys. If it's an uptrend, and then and it sells if we want to if the market is an uptrend, and then buys if the market is on a downtrend, and so on. So, and now the whole of this from here to that level above there is what our swing structure. And then now you wait for the market to give you what substructure. That is our protected high. Okay, that's our target always, first target always. And then here is our structural liquidity, right? So the whole of this is our swing what structure. So now what you want the market to do is you want the market to come to just give you substructures and then come, all right, then take out this high, this area, then take out this area, okay, tap into your PY, okay, tap into your PY, and then boom to the upside, to the target, your first target. You can decide to have other targets, but always make this your major target. And you can just hold some positions at break even to that high. Okay, this is what your substructure, right? So I hope you just take note that this video is recorded. You can replay it at any given point in time to get the logic of what I'm saying. So it will always be here for you guys. So here is what your substructure. So text, right? Let me make it black and white. Okay, substructure. Okay, so that's that. So you see, as a substructure, this is our swing structure. So have that in mind, guys. White, okay, swing. So whatever, I don't know, I'll just leave it like that, guys. So that's that, guys. So now let's look at some. Now okay, let's consider, let me invert it. If is a downtrend, so if it's a downtrend, you still look for the same thing. Okay, just the same thing. But you have the sweep of liquidity, there must be a first break of structure, and then there must be a pullback which must be up to 50% of the FIB, and then there must be another break of structure. Okay, that where the break of structure happened and they ended before that pullback, before coming back to sweep. That's our protected high or protected low in this particular case. So, and the whole of the structure here, from the swing high to the swing low becomes what our swing structure, and then this movement back to take out this liquidity becomes what your substructure. So I hope that is actually noted. So I'm just gonna go ahead and just clean this. All right, so now let me return the chart back. All right, so now we're just going to look at an example here on gold. Okay, so now do we have, this is just a little example, the first example. Okay, so right here you can clearly see that I'll just zoom in a little bit. Okay, let me just go to the 1 hour time frame so that it will be clear. Okay, let's do this together. I'm just going to look at two examples, and then you can always play the examples back and forth, and then so that you can get the whole thing for yourself. So right here, yeah, the market is actually moving to the upside. Okay, we have a pullback. Right here. Okay, so as the pullback happened, what happened? We have a push to the upside, and then a push to the downside, which caused what? Sweep of liquidity, and then there's a break of that led to the break of that structure, this structure here. Okay, already there's other breaks of structure here, but we don't want to pay attention to that. So because those are minors. Okay, that break of structure did not just cause any major highs. Okay, so now the thing is this. We have sweep of liquidity here. Okay, with the key method which I trade, okay, we have with the first method which I taught you guys, we have a sweep of liquidity. Yeah, so that sweep of liquidity led to a break of this minor structure and also led to this. Okay, so but we are going to consider the break of this high structure here, right? So we're going to consider a break of that structure, the high structure, right? So that becomes our break of structure. All right, so but then if you want to consider this, let's take our Fibonacci 2 for the second method. It's not up to 50%. So and ordinarily this everything inside of here is just a substructure, everything until the break of this. Okay, till the break of these and the forming of that, everything inside of this becomes what? Substructure. Everything is the swing structure after the break of this. Now what I'm trying to say is this: everything inside from here, from the sweep of liquidity, okay, everything from the sweep of liquidity, okay, from the sweep of liquidity to until the break of structure, everything inside of there is what? Substructures until that break happen. Okay, we have our protected low, and then we have our protected high. So that was the highest point the market got to, right? So and what is there is this: the whole of this now becomes what? The whole of this becomes what? Your swing structure. Okay, the whole of that becomes what? Your swing structure. So you can clearly see that the whole of that becomes what? Our swing structure. So the whole of that becomes what? Our swing structure. And then now you can clearly see how the market followed the substructure, right? Follow the substructure all the way to the downside. All right, and now there's something to do here. Like I explained in the previous method, you pick, after you have determined those, you pick your Fibonacci. You want a key level where you'll be interested in what taking your buys or sells. Okay, so from the swing low to the swing high. All right, so at this point you want to be actually taking your buys or sells. So now is to determine, the next step is to determine your premium and then your discount. Here is what? Our premium, and then here is what? Discount. So you wait for the market. After that, you wait for the market to actually what? Come down to the discount. When the market gets to the discount, what do? Just go ahead, delete those other candles, and then pick your Fibonacci 2. From there, you adjust it to where the first break of structure happened. All right. So there, then you mark up your premium. You mark your premium, and then you mark your discount, your discounted area, your premium area, and then your discount. Your discount level is the level where you want to be checking out entries. Okay, you want to be checking out entries. So now you are going to mark a demand zone. Okay, you're going to mark a demand zone at your discount. All right, you mark your demand zone. So you mark your demand zone and wait for the market to actually trade into it. Okay, and then the next thing you look for is confirmation. Okay, confirmation, rejection candles, when the market just taps into there. So here we go to the 4 hours candle, and then I think we have the confirmation there, and then you take your trades, guys. So anywhere you just have the confirmation is where you're just gonna take your trades. Okay, so you see, you just take your trades from here, and then you see, like I said, you always target there, and then your stop loss can just be below the 4 hours candle, all right, or below the protected low. So see where the confirmation, where I said confirmation, when you use confirmation, you see you put it at the confirmation at the close there, and then here you're making 1:12 risk to reward ratio. All right, you are not just scared of stop loss or anything. So that's that. So at looking at gold, we still have another example with the second method, which I thought, okay. And then there's also a trade that made me a $600 to about 33,000. I'll be showing you guys that particular trade. That was US oil. So I'll be showing you guys that particular trade. So looking at gold, we have the second method, which I explained, okay. I have some setup here, okay, like I said. So right here on gold, remember the second setup, there must be what a sweep of liquidity, like I said. So you have a push to the downside, the higher low, and then there's what a sweep of liquidity, all right? And then we have a first break of structure to the downside. So we have a break of structure to the downside. So this is a break of structure, okay, our first break of structure, and then this sweep here gave us what a protected what high, okay. So and then there must be what a pullback. You pick your Fibonacci to from the high to the low, okay. You see that this is more than 50%, and that what provides what structural what liquidity, okay, and the market will come back to take it, all right. So then we have a second break of structure, okay, second break of structure. So we have a second break of structure, all right. So we have a second break of structure. Now what do you want? You want to wait for the market to come back, all right. Sweep what you are in, give you an entry, which is confirmation entry. So like you can clearly see how the market just swept that area, okay. You can just take your trades. I know if you go to the smaller time frame, you're going to see a confirmation. So you swept it, you can see that. So you see there is that sweep of liquidity and boom to the downside. This is actually massive, guys. This is actually massive. So see how this is actually massive. You can see this with your own eyes, guys. You can clearly see this with your own eyes, and I advise you to go back to your own charts and do the homework, guys. Do the homework, guys. So a lot of you guys don't want to do the homework. There are informations. My information, what I'm teaching you guys is top notch. So look at this again. I want you guys to actually look at this chart from here. All right, you can clearly see it, guys. It's there. I don't just that there are own market. All right, so here we have what the sweep of what liquidity, okay. We have the sweep of liquidity. We have what a break. We have what break of structure. Know that this sweep of liquidity will give us about protected high, and then now you wait for what a pullback. Okay, you use your Fibonacci to from the swing high to the swing low. We have more than 50%, and that gives us what structural liquidity. So this is a trade which I'll be looking to take in the next couple of days. Structural liquidity, and then now what happens? You have your second break of what structure to the downside. This is your first break of structure, okay, your first break of structure, all right, and then this is your second break of what structure, all right. See everything all perfect, guys, and then this is what your POI, your point of what interest, where you're waiting for the market to just come take to tap into it, and then you take your sales, and then here is your target. All right, so there is your target, guys. You can decide to target, yeah, your first target here can be your second target and all, but that is no business of mine. Okay, so see here. All right, now let's just go to the US oil. Okay, let's just go to the US oil. All right, so let me just load up the chart. Okay, US oil, okay, it's at 73 $29 per barrel. Per I don't know, I think so. I don't know. That's no business of mine. So looking at this here, you can clearly see that we have what? Looking at this here, okay, this is what I was looking at. Oh, okay, we have this sweep of liquidity, okay, we have that area high there. Now Okay, yeah, I will explain my reasons for actually taking that trade. Okay, we have this being we have a sweep of liquidity here. Yes, checked. All right, remember it was the second time I was actually trading the setup. Okay, so it happened the first time. We have a sweep of liquidity, we have a protected high. All right, first, before me taking that trade here, I remember taking the trade here, right? I remember taking it from that area, which I'm just deleting those things down. So we have a sweep of liquidity. We have that sweep of liquidity gave us what our protected high. So we have our first break of structure. Okay, checked. Okay, first break of structure, checked. And then now we have our second break of, we have the pullback. Okay, we have the pullback. This pullback must be up to 50%. Okay, from there to here. So it's more than 50%. That gives us what structural liquidity that will be taken up, that will be swept later. Okay, so and then the market gives us what, a second break of structure. Okay, so this is our second break of what, structure. So now what happens? The first target. So the whole of this becomes what, your swing structure, and then this pullback is your substructure. Now let's see, you enter your trade at the PY. Here's your PY. All right, there is your PY. Okay, here is your stop loss. So imagine that, you see that confirmation candle, right? See that confirmation candle. The first time I was almost taken out. Okay, the first time I was almost taken out, but I just held my trade. 1:8 weeks to the wall ratio. And then now and again the market came back. Okay, so therefore what happened here is this. All right, let me just go ahead and delete these shandes. Okay, I'm just gonna go ahead, there's no time. I think we have taken more than 30 minutes for this video. Okay, and it's very, very informative and rich. Okay, so right here we have a PY here. I have a PY. Okay, and then we have a swing here. We have this area here. Okay, because we have a sweep here. Okay, we have a sweep, right? And we have a break here, and then we have a pullback, okay, which is, if you check, is more than 50%. Okay, you don't expect this thing to be all perfect. And then we have another break of structure, which is this. Don't expect it to be all perfect. All right, so we have another break of structure, which is right here. So this becomes what, my PY. Okay, first break, and then the second break, pullback, which is the structural liquidity. And then what happened is this, my target was right here. Okay, target was right here. So because that was the low the market got to before, this was a structural liquidity. The whole of this was a structural liquidity, and then, so the thing is, I took this trade. Why? Because the market gave me these confirmation candles, right, on the 1 hour. So, but then I knew it was kind of a bit risky, because the market has actually respected this area before. So that confirmation candle was the area where I took this trade. I'll just show you guys everything, plus my trading view. I'll just upload it here. So so you see, because of that, I just had to take my stop loss a few pips below that area, because there was a supply area there. So my stop loss was just above that supply area, and boom, to the downside. So this was a very, very big weeks to the wall ratio. So I'm just going to end this video here. Hit that like button if you love this video, and follow us on the Telegram channel. I'll be giving you guys wonderful setups, guys.